Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today I'm joined by a special guest, Brent Winton, Chief Futurist from ARK Invest, to talk disruptive innovation investing. So welcome back to ETF Market Insights, Brent. It's good to have you.
Thanks, Erin. Thanks for having me.
So a lot of you will be familiar with ARK. For those of you who are not, they are an investment manager based out of the States, focused solely on disruptive innovation investing, founded by Cathie Wood, a name you'll probably be familiar with. And they provide solutions for investors who are interested in gaining exposure to innovation themes like artificial intelligence, genomics, and the next generation of the internet, to name a few. And BMO has partnered with ARK. We've brought 3 of their flagship ETFs here to Canada. So I think we have about a year and a half of track record on those, but they are the same mandate as the 3 offered in the US, but they trade here in Canadian dollars. So those are ARKK, the BMO ARK Innovation ETF, ARKG, the BMO ARK Genomic Revolution Fund, and ARKW, the BMO ARK Next Generation Internet ETF. So definitely check out our website if you want to learn more about those. These are great options for those investors here in Canada who are looking to avoid that currency conversion. And they do trade at about the same management fee as their US counterparts at 75 basis points. All right, before we get started today, I just want to highlight that we are not providing investment advice or investment recommendations. Today's show is all about providing education to Canadian do-it-yourself investors. So exciting to have Brent with us here today. He is focused on research at ARK. As I mentioned, his title is Chief Futurist, and he's focused on 5 major themes. So those include, again, artificial intelligence, robotics, energy storage, multiomics, and blockchain. And today we'll get into some of his thoughts on these and some of the research that they released a couple months ago in their Big Ideas report that you can find on their website. So Brent, without further ado, let's kick things off. I'm hoping you can give us a bit of an intro to ARK Invest and your process. What are the key factors that you consider when selecting investments in your portfolios?
Sure. I mean, we believe, as you alluded to, that it's a unique time in technological economic history, and that investors really need to aggressively expose themselves to innovation, given how rapidly kind of the innovation cycle is moving and how dramatically it's going to impact the world over the course of this business cycle. And so at the specific security level, we have a required rate of return when we're underwriting positions of at least 15% compounded, so a rough doubling over 5 years. And right now, given how innovation is being treated in the public markets, actually we have materially higher expectations for almost all of the positions in our portfolio. So I think that people are unintentionally short innovation. They might not even realize it. If they have a core index exposure, they have exposure to retail bank branches and freight rail. And we think that EV autonomous trucks are going to be cheaper per ton mile than freight rail. And so those rail assets are going to be put into distress. And so if you have kind of like rail in your existing portfolio, you're unintentionally short EV autonomous trucks. So you better own a lot of EV autonomous trucks to make up for what those are going to do to your rail exposure. And it's not just in where they're invested. I mean, given the pace at which AI is moving, people own small businesses. They have jobs that they think are relatively stable, and those could get disrupted by disruptive innovation. So it's important for people to really just risk complete their life with a major innovation exposure. And that's how we approach kind of the asset allocation is how does it pair up against our expectations for the technology? And then, given a reasonable expectation for the growth of these companies, what are they going to be worth 5 years forward? And that's how we allocate the portfolio.
I like that, looking at it as almost like a hedge of what can happen if these disruptive innovations do take shape over the next 5-10 years. Out of those 5 major innovation themes, which one are you the most excited about?
Well, they're increasingly interlinked and call it entangled. The acceleration in artificial intelligence is pulling forward our expectations across all of our technology categories. It's very clear that people are sensitive to and playing with artificial intelligence systems today because they are so performant and the space is moving so quickly. And kind of like the introduction of ChatGPT, that same architecture is powering kind of autonomous robotaxis for Tesla. It's powering the innovation that's happening at the front end of drug development efforts. So we think over time will reduce by half the cost to get a drug into the clinic and reduce time by half. It's moving forward our forecasts for robotics and really performative robotics that can operate alongside humans in the world. And it pairs really well with smart contracting platforms in a world that we think will increasingly be kind of driven by automated blockchain-based allocation engines that are going to change the way the economy works. So kind of the acceleration in AI is exciting, and actually some of the, we think, real value is in spaces that are adjacent to AI that are going to be empowered by the advance that we're seeing in AI today.
So touching all different industries. And I've been reading a lot about how a lot of experts are totally surprised and shocked by the growth that they've seen in AI. I know you guys have very aggressive targets already, but are you surprised? Does anything surprise you about AI anymore?
Yeah. I mean, so we think that costs are declining on a prospective basis by 4x per year, meaning that the cost to train an AI system today, a year from now, it'll be 1/4 the cost to train a system that's similarly performant. And so if you think it like the comparison to traditional technology, this means that costs are falling in half every 5 months. In traditional technology, costs fall in half every 2 years. And so it actually scrambles the innovation cycle to some degree. There's this famous saying, I think it was Bill Gates that said it, that we tend to overestimate what's going to happen over 1 year and underestimate what's going to happen over 5 years. And he was basing that statement based upon, a 2-year cost decline. Now it's happening every 5 months. So really we tend to overestimate what's happening every 3 months and underestimate what's going to happen over the course of a year or a year and a half. And that's very much where we are in the stage of AI, where kind of the video generation models that came out earlier this year were wildly performant relative to what we expected. Perhaps a little understood is that those video generation models are also illustrative of a capability that will inform robotics efforts and our ability for a robot to understand and drive through the world. And so kind of like the acceleration is proceeding across all of the different sectors. And then because you have costs declining and investment dollars pushing in, you can combine the two to say, hey, between 2 and 3 years from now, we're going to have an AI system that's 100 to 1,000 times more performant than the one that's available today is. And so I think it's very easy to even over-index on present capability. I think really this is going to change every business, every sector, and even relative to our forecast, it has been happening more quickly than we anticipated.
Okay. Let's talk about chip making giant Nvidia. It seems to be a question that we always get. Most common question when it comes to your mandates is, why did you sell it? And we did see a bit of a pullback last week, which was interesting, but curious as to your thoughts there and what companies that you feel have like higher growth opportunities, what you've replaced it with, basically.
Sure. So Nvidia, I think across the life of our fund was the 4th largest contributor to returns. So we did anticipate, and actually when we were first investing in Nvidia, many people thought it was like a video game chip stock, and we were investing because of the AI enablement that it would create. And now, Nvidia is expected to do on the order of $100 billion in chip sales over the next year or two. And if you think about the math of that, that means somebody has to be able to take those chips and convert them into software products that, are worth $600 to $700 billion in revenue per year. And so there's literally trillions of dollars of potential AI software out there that is not being recognized by the marketplace today. So we think that the right place to play is in the AI software part of the stack, and in the autonomous robo-taxi part of the stack, and in the drug development part of the stack. So for Nvidia to work, their chips have to produce a lot of upside for somebody, or else the people will stop buying them. And so, and this goes back to, I described our valuation discipline. If we underwrite a position and over 5 years, even with our aggressive expectation, it's hard to make kind of the investment work. We're not going to be shy about rotating into other opportunities where we think that the future value hasn't been discounted by the marketplace. There's another wrinkle in Nvidia where it seems increasingly likely that actually energy will pose a constraint on the ability to build out data centers. And so that might back into kind of customers' willingness to aggressively buy AI chips today, because they have to solve another problem before they can deploy them. And that's part of, Nvidia pulled back in part probably because Meta has said that they're going to vertically integrate into chips, and Zuckerberg emphasized that they're doing that. And other Nvidia customers are as well, including Tesla. And I think that, Nvidia is an amazing company, and at the right price, we would invest aggressively again. Right now, it's hard to underwrite given how expensive it is.
All right, perfect. And let's talk a little bit more about Convergence. You did mention it off the top. Big ideas, that was a huge theme. You wrote a whole paper on it, and there's a video on your website going into it a bit more detail. But what does this really mean for investors, and what are some of the other opportunities that exist when it comes to these themes converging?
Yeah, so all of these technologies are cross-catalyzing. As I described, an acceleration in AI actually leads to an acceleration in a lot of other things. And we quantitatively dimension the degree to which these technologies are dependent upon each other, and how an acceleration in one leads to an acceleration in other technologies. And in that dimensioning, it reveals that artificial intelligence and deep learning neural nets are the most important technology in terms of a catalyst for other accelerations. Across all of the technologies that we cover, we believe that by 2030, almost it's 60% of equity market value is going to be disruptive innovation exposed. And it's in part because of this kind of convergence and cross catalyst between technologies, where the robotics opportunity is, at least from our perspective, much larger than it was even a couple of years ago, because previously we were concerned that, hey, the software wouldn't be ready to allow these robots to operate in the world. Now it seems clear that they are. If you can deliver a robo-taxi that works and drives a lot of miles, that captures a lot of data that then allows you to train your model to make a robot operating in a more unstructured environment actually work. And so kind of there's lots of interlinkages where you can develop one capability that makes another capability available. And we think that's what's happening technologically right now.
All right. You talk a lot about blockchain too, and public blockchain in particular, and there are a lot of misconceptions around what it does. So walk us through that and tell us a bit more about the benefits that you see blockchain having for us in the future.
Sure. We think of kind of public blockchains as kind of disaggregating into three major areas of innovation, three major technologies that we focus on. One is cryptocurrencies, and Bitcoin is the preeminent example of this. And so this is really a kind of an auditable, censorless money, meaning that I can transact it with someone else without anybody having to stand in the way and potentially stop me, that we believe that's going to operate all the way across the world over time. It really is the right way for kind of transactions to be cleared and settled. And it'll be a competitive money, particularly in emerging markets. And, over time will become something that people think of as an alternative to the US dollar or the yen. But right now it's probably best thought of as a displacement of digital gold, or a digital gold that can displace, that kind of hard money. Then there's smart contracts, and smart contracts, the idea here is that you can encode traditional financial functions in a set of protocols that are automatically executed on a public blockchain. So what do I mean by that? Right now, imagine I'm a dentist in Florida and I have risk of what Medicare's reimbursement rates are going to be. I kind of just have to deal with that risk. It might change over time, but I can't do anything in my business to help me. I could go to like a big investment bank and say, hey, can you like allay this risk to me? Can you sell me something that basically hedges out that risk? But they're not going to be willing to do it because I'm just a small dentist and they can't afford, the lawyers and kind of the structured note guy to accommodate me because I'm just too small potatoes. Conceptually, with smart contracts, you could provide that risk mitigation to even the smallest person in the marketplace because you don't have to have Morgan Stanley's balance sheet and lawyers behind it to allow me to trade away that risk. And so over time, if you look at the entire financial services industry, the financial services industry takes more than 3% of kind of GDP or of financial wealth out into kind of managing it. And we think smart contracts will be able to do that for a third the price. And so you'll end up with more even economic activity with less of a drag from the financial ecosystem. And so that's the smart contract side. It poses a risk to all of the traditional financial intermediaries, and we believe it's going to take share over time. Right now, it's very early days, less than 5% penetrated, and much less actually. And then the third category is what we think of as digital wallets. And this is the idea that the front end of your financial life is going to be managed through a smartphone, not through a bank branch, and that poses a risk to traditional banking services. And so right now, the largest financial intermediaries in the US, as we think about it, is Cash App and Venmo. That's where they have the most active users and unique accounts relative to all of the other traditional banks, and they're able to increasingly deliver financial services right through that app. And this ties in with what's going to happen in the cryptocurrency and smart contracting side, and it enables it. And so those are the three kind of categories that we focus on, and there are different provocative exposures to those in different companies and in markets.
Lots of catching up to do for some of these older institutions, for sure. You and the team are also very excited about multiomic sequencing. So you mentioned it can unlock entirely new programmable biology capabilities in your paper. Explain what multiomics is to us and describe how you see this data fitting into the healthcare sector. I'm so excited about some of the curing rare disease data that you have as well, but walk us through that theme.
Yeah, so within kind of multiomics, there are three categories of things that we focus on. One, there's kind of like multiomics technology itself. The idea here is that, we are increasingly able to measure everything that's going on in our body in a precise way. So the recipe for our body is our DNA. Now we can get a gene sequence, but then there's another layer of stuff on top of that, which controls which of your specific genes actually get expressed and to what degree, and we can measure that. And you can now increasingly measure the proteins that are created on the back end called the proteome. And with your, digital health devices, you are getting a better measure of what's actually going on with your body over time. And being able to combine all of that data to understand what's happening with people allows us to more precisely identify and deliver treatments to diseases. And so particularly on the cancer side, if you can measure a cancer precisely when you know that you have it, you can direct a treatment more precisely. And then once you've knocked the cancer into remission, the old standard of care was, well, you take pictures of yourself basically. And then once you see it coming back, you try to treat it again. Now you can do what's called minimum residual disease testing. So you can look for the multiomic signals of that cancer with just a blood test, and you can detect it 10 months earlier than you would see it on a scan. And so you can begin to address it again before it grows really big and hairy and poses a real problem for you. And so across the entire kind of like healthcare space, but particularly in cancer, we think multiomics is going to change the way things work. Then there's the precision therapy side. You talked about rare diseases. So there's now effectively a cure for a disease called sickle cell disease that directly edits the genome of people that have it. And so sickle cell disease is a terrible disease. If you have it, you live to an average age of 50, you have to go to the hospital multiple times a year. It's very expensive and painful to have. And so with a single modification of the genome, it looks as if we can allay all of that cost of hospitalization and allow people to live a normal life. And so you can imagine you're avoiding, tens of thousands, sometimes $100,000 plus in costs per year. So the value of that treatment is very high, on the order of $2 million, because you are not only kind of like avoiding all those costs, you're also giving somebody a long, healthy, and normal life. And so we think actually Wall Street doesn't really understand the implications of the fact that you're going to be able to sell in a cure to patient populations. It changes the way in which revenue is going to be recognized into these companies and the degree to which they're going to be threatened by generics and competitive products. So we think that it's just happening basically this year. And we think that there's going to need to be a recognition of the value that these companies are delivering and how they can kind of capture in markets. Then the third category is programmable biology, and that's really emerging, but it's taking the multiomics technologies and the precision therapy technologies that allow us to directly manipulate biological kind of like tools. We can build up, incredible ag bio products and really kind of directly manipulate the biological environment to create new materials and potentially biofuels as well.
We did a ETF Market Insights episodes, I guess it was a couple of weeks ago now, about demographics and changing demographics and how people are living longer. And I'm sure none of this data was accounted for in those studies. So it just, reinforces the importance of, planning for the long term, because we're all going to be living longer soon. Let's change gears to autonomous taxis now. You say they may have the most impact on GDP of any innovation in history. Would love your thoughts on that space and Tesla in particular and where they're at with their Robo platform.
Sure. So the idea here is relatively simple. We spend a lot of time driving in cars and we don't get paid to do it. Actually that's a huge waste of human potential. The fact that we are, navigating around these vehicles rather than using our beautiful brains to like think up novel things or read novels or watch Netflix. A robo taxi, we think, system like Tesla's will be able to price profitably at less than 50 cents a mile. You can imagine instead of taking an Uber for $3.50 a mile, you take a robo taxi for less than $1 per mile, and you don't even have to deal with the uncertainty of the Uber driver. And so people will change their habits. They'll change over from driving themselves to being driven around because it'll just be more convenient, and they'll free up that time to do other things. So the ability to go from place to place is actually an amazing privilege that we have. And right now we're doing it with, on average, $45,000 pieces of equipment that spend 95% of their time parked. And so it's actually a really inefficient way to get from place to place. Robo taxis will be able to operate, maybe 10 times as much as traditional vehicles. And so you'll save on the fact that they're not parked all the time. They'll be operating all the time, and they'll be on electric platforms. So their cost per mile will be very low. Tesla specifically it clearly has the highest leverage to this idea, because even over the last few months, it's become increasingly clear that they think they are about to commercialize, and they're committing, real resources to preparing for that commercialization. So in August, they're going to repeatedly announce their robotaxi specific model and unveil what it's going to look like. And for Tesla, it really transforms the economics of that business. You can imagine if they sell a Model 3 and they charge $50,000 for it, they might get $5,000 in operating profit off of selling that vehicle. And so the difference for them, if they sell that Model 3 and it's capable as a robotaxi, we think it could go 100,000 miles as a robotaxi and generate $1 per mile. There's 1 trillion miles addressable to $1 per mile. So then Tesla will take a platform fee just like Uber or Lyft. And so if you assume the platform fee is 50%, and then you assume they only get a 50% operating margin on that, that's still $25,000 in operating profit on that vehicle for every year that it's, driving around. So they go from like a one-time $5,000 operating profit event to $25,000 per year in perpetuity effectively. And so the entire business begins to spill off cash in a way that's a profound transformation relative to how it currently works. those are all rough numbers, but it's roughly the way to think about the opportunity is they right now only make money one time off of selling a vehicle that they've had to produce a giant factory to produce. And, it's very capital intensive to kind of all of the vehicles they've sold become revenue generating to them on an ongoing basis annually, and with much better margin and capital intensity characteristics.
Very cool. A theme of your investment philosophy is that these innovation platforms are going to account for the majority of the global equity markets by the end of the decade. Where do you see the more traditional asset classes falling in the next decades? Why should investors consider adding some of these products to their portfolio?
Well, I think it's an interesting question. I mean, I alluded to it. I think that people don't realize how short innovation they unintentionally are. And even in the ways that they're exposed to innovation, they might be exposed to companies that seem like they're safe bets, but could be disrupted. So, Google, I'm sure, is in almost everybody's portfolio. And for good reason. Google search has been a remarkable cash flowing business. It's almost like a business miracle. And it's very clear that large language models actually put Google search at risk. Google search makes money by charging a toll to deliver you from the search result to the website where you want the actual information. What large language models do is they take all of the information that's out there and they deliver it right to you. So you're no longer bouncing from the search result to somewhere else. So how Google responds to that new reality, they have so much kind of built up processes invested in the economics of the search business. It's really interesting. Like it really could be an innovator's dilemma type event for that entity. And leaving aside the big tech companies, which I think are facing more uncertainty and risk than they faced in quite a long time, across sectors, it's very clear that the acceleration in AI is going to change things, and companies that aren't agile and innovative are going to get left behind. And so I think a lot of companies, Boeing's an example, that have been kind of optimizing for cash flow rather than optimizing for intelligent people that are able to adapt to changing conditions are going to increasingly be revealed to have accrued essentially talent debt over time that then will leave them out in the cold as kind of like AI sweeps through. And so I think that there's a lot of businesses that, could be put to risk that seem like they are stable and cash flow generating today. I mentioned retail bank branches. What it used to be, you selected a bank based upon, the ATMs that were around you, right? And so the bank branch network was very valuable because like the marginal depositor would come in and be like, oh yeah, I saw Chase ATM over there. This is the bank I'm going for. That doesn't really apply anymore, at least for many, many people. And it's because they have a digital wallet that allows them to, operate independent of the physical infrastructure. But banks have a lot of money invested in those bank branches. And so there's a huge capital misallocation that's hard for them to elegantly decay out of. So that's just an example. I think that various sectors will respond in various ways. But for me, the main thing over the course of this business cycle is, one, you have to cover your unintentional innovation short. And then we think that kind of these disruptive innovation platforms are going to roughly go from, it was $19 trillion in enterprise value at the end of 2023 to more than $200 trillion by 2030. So roughly 10x. And the way in which you really generate long-term wealth is by, exposing yourself over the long term to that kind of tailwind. And I think that a healthy dose of innovation that is part of your long-term money is a really important part of that puzzle.
Yeah, definitely. And I think it's just a low correlation asset class to add to your portfolio also, as you mentioned, makes sense. So thanks, Brett. A reminder that ARK's mandates are considered growth mandates. So they come with that high risk rating. It's, something to consider in terms of how this fits in your portfolio. We see investors using it as a satellite position to a core portfolio. to add that differentiated return stream to hedge against the risk of disruptive innovation. But just highlighting that a lot of these themes are that over that longer term time horizon, we're going to see them play out. So not in the next 1 to 3 years, but the next 5 to 10 years, more likely. So consider how that fits in your investment objectives and have that longer term time frame when investing. Thanks again, Brett, for... Yeah.
I'll just add one more thing, which is, yes, this is not for your, like, I'm investing this to take it out tomorrow, right? Like this is the like long-term wealth generation is where you need to put innovation, because it's by its nature volatile. And right now, I have never in my time in markets experienced simultaneously like a need to upgrade my long-term forecasts. A need to really be like, oh, we were wrong about how quickly AI is moving. We actually need to be more aggressive here. Coincident with the public equity markets treating innovation like it's some kind of fever dream that we all had during COVID, and it's never going to return. And so there is like I think both strategic need to expose yourself to innovation, and then there's also probably, tactical advantage to the degree to which all of these assets are long duration, and so they're very interest rate sensitive. If there's a turn in the interest rate cycle, which presumably will happen at some point, there probably should be a consequent relief rally in this asset class. And so there's like both the build up a strategic position, and then there's the tactics of, hey, it's right now it's trading as if there's no long-term value in these assets. And so, which is why we can, when we underwrite positions, we think it's great. This is an amazing opportunity to get innovation exposure. And so I think that plays into the calculus as well.
Absolutely. All right. Thanks, Brett. And thanks for your partnership. Those are great insights. I encourage everybody to check out the Big Ideas report on the website. And you guys have put out a ton of video resources as well, which are always nice. So check out BMOETFs.com, check out ARKinvest.com. I always leave my discussions with ARK just feeling very excited about what the future has to bring. So thanks again, Brett.
Thank you. Thanks for having me.
Next week, we will be back and we'll be discussing buffer ETFs, so what they are and how they can fit in your portfolio. I'll be joined by my colleague, Chris McKinney, who's going to walk through some of the key considerations when it comes to these ETFs. So I hope you'll join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.